good morning to you. In business news at this hour, analysts are still looking at the recent collapse of global banks with a fine-tooth comb as the matter continues to cause worry over the sector. Authorities have reassured the world economy that the situation is stabilising following state intervention, but the manner in which Credit Suisse, along with Silicon Valley Bank, collapsed remains under scrutiny, particularly the write-downs of subordinated debt. Portfolio manager at Foord Asset Management, Rashaad Tayob, joins us for this discussion. Thank you so much for your time, Rashaad. I think one of the biggest questions that remains is following the paper trail and what exactly transpired, if we can lay the ground for how these banks found themselves at a point of collapse in 2023.
Morning, Tomi-san. Yes, it's just to look at the background of what happened that we ended up with the U.S. banks in crisis across a broad range of banks. Over the last year, we've seen the most rapid increase in rates since the 1960s. So we've had rates go up from 0 to 5%. That is a dramatic rise in a very short space of time because inflation has been higher. And what you found is that banks were invested in long duration bonds. And when rates rise, the price of bonds fall, and they found that they were sitting on losses of close to $1 trillion, which is half the capital of the system. So as the market became aware, investors became aware that certain banks were undercapitalized, were technically insolvent, they began to withdraw money, and that precipitated a bank run, a modern bank run, which doesn't happen over a couple of weeks as people queue up outside banks. It happens instantaneously as people withdraw on the internet. And you saw over the course of 3 days, Silicon Valley Bank lost almost $100 billion worth of deposits. And by Friday midday, the government officials, the Fed, had to step in and effectively take over the bank and work out a resolution over the weekend.
Now, Rashaad, what does this say about the state of regulations within the global banking sector? If failures can be picked up and holes can be picked at when it comes to how these matters unfolded and where reform needs to take place going forward?
So I think it's a massive indictment on the regulatory environment. Everyone is piling on the bank management, and I think that they were at fault because they didn't take care and hedge their interest rate risk. But at the same time, the regulators put banks through stress tests. They released quarter reports which said that everything was fine, but it turns out that they weren't even stress testing the banks against rising interest rates, which as a South African, we're used to interest rate volatility. That would be shocking. But in the U.S., they're just so used to a very low or zero interest rate environment that even the regulators hadn't anticipated the fact that interest rates would rise, much less rise as dramatically as they did. So the finger definitely has to be pointed to the regulatory environment, which encouraged banks to buy long bonds. They then took the losses, but they didn't stress test the banks properly, and therefore depositors weren't aware. And it wasn't a surprise that they panicked and fled as soon as they realized that the bank was technically insolvent.
Interesting, because that also has brought into light questions around where the South African banking regulatory system stands. We've been lauded as quite resilient and using different models that would cushion against a crisis like this.
Yeah, so the South African banking system functions a little bit differently because we are very much in a floating rate system. So the banks borrow at floating rates, they lend at floating rates. When they lend to a corporate, that corporate will pay a floating rate which changes with the repo rate, and it's that corporate's responsibility to hedge their interest rate risk or protect against interest rate rises. The bank doesn't necessarily have that bigger problem. The banks do hold some securities, and they haven't taken losses similar to the global banks in terms of the securities they hold, but it's nowhere near the scale of what has happened specifically in the U.S. And I think our banks in general are better risk managed because we are used to a volatile environment. We're used to interest rates moving around. We're used to the currency risk. We're used to political risk where things can change quite dramatically. So our banks are a lot more aware of risks and what can go wrong, and they are reasonably capitalized. The risk obviously in the SA market is that we sit with an economy which is really struggling and unable to grow.
Rashaad Tayob, thank you so much for your insights. He's portfolio manager at Foord Asset Management, talking to us about the continued scrutiny around the recent global banking crisis.